Okay, I've got a treat for you today. We are having a conversation with Steve Young, not the football player, former football player, but the CPG legend, Steve Young, the former General Mills, former Sunrise Capital Partners, former run your own 9-figure frozen food manufacturing business, current managing partner at Manna Tree Partners, the legend Steve Young. You are in for an absolute treat in this conversation. Steve has such a rich history in consumer products and has seen both sides of the table and really gets it and really understands what it takes to be successful in building a durable next generation brand. And so I asked him very directly at the beginning of this conversation, has the fundraising well run dry? The rest of the conversation gets really good, and I encourage you to take some notes because we're going to talk about, understanding the investor perspective. We're going to talk about the importance of human connection in business. We're going to talk about founder psychology and leadership and at various stages, and we're going to talk about how to present your mission and financials, and we're going to debunk a few fundraising myths, and then talk a little bit about the trends that we all see and what Steve thinks about the trends that are going to lead sort of this next wave of innovation. You are not going to be disappointed with this conversation, and I'm really honored that you're here to listen to it. I think you're going to get a ton out of it. Let's jump in. Steve, I am so excited to talk with you today. You and I have a relationship that goes back several years now, which is kind of crazy to think about. In one vein, it feels like we just got to know each other. And then in another, it's like, holy cow, this has been a few years.
In the trenches. I like it, though. It's good. It's great to be here, man.
And it's all in the trenches. I'm glad you said that. I'm glad
Exactly.
you said that. Yeah, I'm glad you said that. Steve, I've got a whole list of questions because I view you as someone, somewhat of an expert here. And because you've played so many roles, operator, investor, you've and at various levels within that, like, I just feel like you have the right view to give such great perspective here. But I want to ask you a really direct question to begin with.
We're going to jump right in, huh?
We're going to jump right in.
Okay, here we go.
Steve, has the well run dry? Is fundraising for CPG brands dead?
So that is like, let's just jump right in. This is Jason's investor conversation. We're going to jump right into, is the fundraising well dry? No, honestly, I got to tell you, I think it's a great question, Jason, and I hear that, myself sort of all the time. And, what I tell you is it's gotten a hell of a lot harder. Okay. So the sentiment of like, man, it's the well's dry. It's impossible. Like, I totally get where it's coming from because again, the bar has really been raised. And when I say the bar's been raised, what it means is that investors of all types, venture investors, growth equity investors, especially in consumer, right now, when you're talking about an inflationary backdrop and, all the large caps that are traditionally the ones that acquire businesses like yours and whatnot, they're getting a lot more choosy, if you will, and whatnot. There's some real macro trends in the consumer space that are making it really hard. And so, from an investor's perspective, you're really looking for companies that are clearly pulling away from the pack and driving differentiation. You're looking for companies that are led by entrepreneurs who get the idea that, okay, I can't just grow at all costs. I got to have a good P&L. Things like unit economics and whatnot really matter. You're looking for companies that have just got insane consumer loyalty, in an environment where every time you turn around, you got a price for inflation, it seems. Do people stick with you? Are they still willing to buy you? Are you still doing the job for them that they're spending their money for you to do? All those things honestly matter so much. And so what's happened is the reality is when interest rates were zero and money was free and, the sort of early 2000s or early 2020s when, we kind of had the quote good times, you had a lot of companies that got out there that just, they just didn't have those basics down, and it sounds brutal. I have so much respect for people like you and any entrepreneur because no matter what you're doing, it's hard. But you just had a lot of people that didn't have their heads screwed on straight as it related to the things that I just mentioned. And so, what you're actually seeing is there's a lot of capital out there. I got to tell you, like there is, in the industry, we call it dry powder, capital that can be deployed. There is still a lot of capital out there, but investors are just being a lot more choosy about who am I partnering with, and am I really, really doing it with a brand that's got real potential to grow and scale, and more importantly, like with an entrepreneur who really has all the things that the tangibles that are really needed to make it work.
I love the answer, and I love that you said that. Would you say that in a low interest rate environment where money was relatively free, that encouraged investors kind of at all levels just to place a lot more bets because the money was free? Is that what happened?
I think there were a lot more bets that were placed at the time. You could take a lot of small flyers, especially in the venture space in the early stages. But then even in the later stages, what you'd find is, look, grow at all costs. Get out there, grow. Don't worry so much about your P&L because, scale will cure everything. And, and then truthfully acquirers, and again, like you said in the intro, I've been on a lot of sides of this whole party we play in. Acquirers would look at a P&L and say, well, maybe the P&L is not great, but, we can internalize it and bring our big skills and our scale and our heft and we'll make it profitable. I think everybody learned that it's not as easy as that. And so, I think when sort of interest rates were zero, you had just a lot more capital flying around out there. You had, other sectors like tech investors, for instance, that got sort of into consumer products and, they brought their capital to the party. And so I think what you're actually seeing, and I know it feels like a well's run dry, I actually think what you're seeing is a return to sort of a normal period where there's going to be plenty of opportunities to win. I mean, have you, I'm sure you've seen the M&A environment this year. I mean, it's been amazing. There have been a lot of really great transactions that have happened. There's still plenty of room for people to win. It's just, it's hard, and you got to have the fundamentals down if you're going to attract capital.
Yeah. No more of this. Hey, look, you got an okay product. You can drive top line sales through promotions and things like that only, and don't pay attention to anything below the line. That doesn't work anymore.
No, that's right.
It maybe should have never worked. Perhaps. I don't know.
I think, look, I think it's interesting to hear you say that because, if I really think about what you're saying, I think you're probably right, to be honest with you, because, I'll tell you, when you lower barriers to entry so much to something that everybody and their brother can get in, you increase the cost of doing business for everybody, including the good ones, and so I actually think that a more normal, rational environment like the one that, to be honest, we're in, is probably healthy over the long haul. And look, to be clear, like there is some crazy stuff going on right now, like all the tariff talk and like, what's that going to mean for emerging brands? And I mean, welcome to the jungle. I mean, as well as anybody, like this business is not for the faint of heart, but it's always something. Yeah. But I do think that we're in a more normal environment if you look at the long arc of things than it might feel to people who are just trying to capitalize their business right now.
Got it. All right. Fair enough. I started the year out. I think I said something in a LinkedIn post that this year, like every year, it's just going to throw you a lot of curveballs. So be ready, be nimble. I think that's the sentiment in entrepreneurism in general. Is like, welcome to the jungle. I love that. I love that statement. You just never know. You got to be ready.
Yeah.
All right. Okay. Well, thank you for that. I get asked that question all the time. People are like, well, is the well dried? Is anybody writing any checks? I would point to the M&A environment as well. I think it's been a pretty remarkable year so far with some of the deals we've seen in the last 12 months, and I think more to come.
Yeah.
Okay. All right. So you've been an operator, you've been an investor, you've been on both sides of the table. What do you wish more founders understood about how people on the investor side really evaluate deals, especially when you get up at north of $20 million of investment? What do you wish founders understood when they came to the table?
Yeah. It's a good question. I think, you know, I'm going to build on what I was saying earlier about just sort of the cost of capital and whatnot. I think, remember, like the first thing to remember is that, like, companies in like funds like Manna Tree, for instance, all the kind of traditional investors that you'd find, what we are is we are other people trusting their money to us to go out and find places, companies to invest in where we can drive an outsized return for them. And those investors, frankly, they could put their money in the bank and make 5% on it. They could put their money into tech. They could put their money into healthcare. They could do anything with their money. But when they come to a company like Manna Tree, they say, hey, look, we believe that, in our case, health and wellness has got a tailwind in the consumer product space. And we trust you to go find companies that are going to really help us, double our money, triple our money, and then some. And I think sometimes, to answer your question directly, it's important for a founder to remember that like, people like me, like when I'm evaluating your company, for instance, like when we're looking at the new Primal, like I'm looking at it as a human being. Like, do I think that it's a cool company? Is it a great brand? Does it speak to me? Do I like the products? What kind of, what do their metrics look like? I mean, there's all those things that you have to look at. But at the end of the day, we have to look at it and say, okay, well, look, can this $20 million company turn into a $50 million company, turn into a $200 million company, for a $500 million company? Not necessarily that we have to do all that together, but can the next owner go and do that? Can a company that's losing money today break even in a year, start making a little bit of money a year later? Like, we have to evaluate all those things, because if we don't evaluate all those things, you can invest in a lot of really cool companies that just don't have scaling potential. And then at the end of the day, we don't do our job, and that's a hard thing to do, because, we're all human beings on our side of the table too. Like, I see so many cool companies out there, and I really personally like so many of them. But the reality is, some of them are just not great ways for us to achieve our mission, which is to drive a return for our investors. And so, when you come in, just remember that, like, show us, here's my path to scale. Here's the job I do for the consumer and why it's so important. Here's proof on, even if it's a small little data point, doesn't have to be some massive spins, thing, but here's proof on why consumers will, spend their hard-earned cash for me, for my company, for my product, over something else that they could spend their money on. All those things really matter, and they end up helping us as investors really sort of find, okay, hey, here are the places we want to lay some chips down and try to achieve our objective too together. Yeah. We're all doing really cool stuff together with people like you.
Yeah, I'm taking notes, just so the copious notes, because I learned from every one of these conversations. Obviously, I have some questions I want to ask you, but you said path to scale, the consumer benefit, the proof point, some proof point that shows that people will spend their dollars with you, how you're going to achieve your collective goals together. Remember that you're investing other people's dollars, so you're responsible for other people's dollars, and that's a big weight to carry.
Yeah.
And then the one that really struck me, Steve, I have to, like, those are things that I'm going to repurpose on LinkedIn. By the way, I'm going to use those. But you said something that really hit me. We're all human beings.
Yeah. Man,
let me tell you how much that gets lost in the emotional gravity of what we all do. Sure. Yeah. Right? Because, as a founder, like, we get defensive. We get, we get all wrapped around the axle about how cool our idea might be or how great it could be, but we're missing some of these really key elements. And then maybe we get defensive, or maybe we respond in a way that comes from a place of stress and anxiety. And you just have to remember that people on the other side of the table are human beings too.
Yeah.
And that, man, that gets lost sometimes, because it's like, hey, I'm a founder and you're an investor, and it's like, we forget that, like, no, you have a family. You have, like, people who rely on you, like, you're like a real human with real emotions, and, like, you're not just this robot that.
Yeah. I mean, look, people like me don't get to do our jobs forever just for free. Like, we all have to, put the the runs on the board,
Yep.
and the magic happens when you find people that it's like, okay, this is 1 + 1 = 3. Like, we can help each other accomplish our objectives, and you might have even, I want to say you might have even kind of mined this a little bit in one of your earlier guests on one of your podcasts. But how many times do you hear like, hey, don't make it personal? This isn't personal. Man, I always bristle at that, because like, this is personal. Like, to me, I mean, it is personal.
Very.
But like, I even think about like our history together, Jason. Like, you and I have been through. We've had tough conversations, plenty of them. I'll tell you, you're one of the people I take the most pride in being able to work with every day, because like, at the end of the day, like, we can have the hard conversation, but we keep our eye on the prize, and we listen to each other. And, that's the kind of thing where, as an investor, I think the other thing that people sometimes underestimate is the people, the human side of our business is so important. It's so important. And, it's the old, are you betting on the horse or the jockey? It's like, that jockey's really important, and I know that's something to remember too, when we start having dialogue like this,
It's super important. And that's why this is a dating process to begin with. In the beginning, it's like, both sides of the table should be vetting each other. And like, do you think, because everything's great, right? Checks written, investments closed, you go to the closing dinner, everyone's joyful, but none of that really matters until like something goes wrong.
Yeah, everything's good until it's not. Totally.
And so I do appreciate that. And so last point on this, and we'll move on. I'm a huge fan of The Office, and it's like been my guilty pleasure for a better part of a decade. It's the one thing that can kind of turn my brain off at night, and I can like watch an episode and then go fall asleep. But Michael Scott used to say it all the time. He used to, over the top, but it's like, this office is a family, or like, business is personal. When he's talking to David Wallace, he's like, yes, and like everyone's always arguing with him, and it's like, it's just business or whatever. He's like, no, this is, he used to just double down on it, like obnoxiously so. But the point is true. Like, business is personal, man. This stuff is.
It is. Yeah, it is. I think especially in our space too, where, most founders, most entrepreneurs in our space have a real personal mission behind what they're doing. Like, it wasn't just, hey, how can I make a buck and I'll go and invent a business. It's some personal motivation that got them into it. I mean, I know your story. It's a great story. Even Manna Tree, our co-founders started Manna Tree out of personal connection to health and wellness. And it's a big part of why I joined the team, a few years ago directly. I saw them in action when I was working with another firm on Vital Farms together, and you see like how personal it is, and really, really, really important and astute to kind of point that out, that it is personal, and that is, I guess the point is, back to where you started. That is very, very much a part of the investment process. The evaluation process that takes place. Like, can I get in the trenches with these people?
Yeah.
And can we win together, even when it's hard?
Yep. Yeah. I think it's lost on a lot of people, because the next handful of questions I'm going to ask you are a little bit more tactical, or maybe even a little bit more like, let's just talk straight business. But I think if we miss that part, then we're missing the whole conversation.
Yeah, totally.
Okay. I want to jump. I'm going to jump ahead here for a second. There's been, a few years ago, maybe longer, but a few years ago, there was this obsession with direct to consumer. There was a D2C like halo and like big obsession. If you could go build the email list and so forth. And then there's this omni-channel reality in the space that we play in.
Yeah.
So, D2C brands, for whatever reason, historically were able to raise early. You could raise on some quick metrics and things like that, at least from what I've seen. But I've seen a big shift away from that. In fact, in some of the conversations I'm having, it's kind of gone the other way. But from your perspective and your perspective at Manna Tree, like, what's the kind of channel mix that gets you excited today?
Yeah. Well, and part of what I think you're getting at there too is that it's just not one size fits all. And again, I know you know this, but just by way of very quick background, Manna Tree is a growth equity fund focused on health and wellness. The thesis on every check we write is, are we putting capital and resource behind companies that help people live better, longer lives, not just longer lives, but better lives. It's the thesis that people like Peter Attia and Andrew Huberman and all these people that are about like, look, what's the point in living to be 90 years old if the last 10 years of your life are spent in some sort of infirm position with chronic disease? You want to live better longer, and so that's the thesis behind everything we do. And I know that's a deeply personal, thing that, I know I've got stories in my background that make that important to me. I know you do. Yep. And so when you think about, companies that help people live better longer, the bulk of what we have done in our past to date has been in the food and beverage, space. Anybody who's tried out exercise, a bad diet. I mean, I've certainly tried, it doesn't work, it all starts with like what you fuel your body with. And so that's at the center of our thesis. And then we'll look at other things like active lifestyle. We'll look at things like, clean home and environment, beauty, skincare. What are the things that actually that we're putting onto our bodies, and what does that do to our quality of life? And so with that as a background, what I'll tell you is, food and beverage, direct to consumer is part of it, but I don't put a lot of stock in direct to consumer as like evidence of scalability, because the truth is, while people will buy products direct, and I know you've got a very nice little Amazon business, for instance. The truth is, most of us are buying our groceries, buying our food at a store, either a store down the road, or you're doing a stock up trip, or you're doing both, or you're using a service like Instacart. And so direct to consumer is sort of the frosting on the cake, so to speak, in food and beverage, And so I want to see an omni-channel mix in food and beverage, just because I think if you don't see an omni-channel mix, there's always going to be a question of, how scalable is this business really?
Yeah.
When you start thinking about like other sectors like active lifestyle and whatnot, I think about I'll give you an example of one of the themes in that whole like longevity and health span movement is, strength training is super important. Movement, super important. Movement, how much you move is the number one predictor, even more so than your age, of how long you have left to live.
Wow.
Just think about that for a minute. Being sedentary is like a killer, literally.
Wow.
And so you look at, what are the businesses that are being built to help people move? Like there are weighted vests that have come from out of nowhere. People will put on a weighted vest when they're out walking the dog, and these businesses are growing, and the vast majority of them are direct to consumer. The vast majority of them are DTC, and you could make the case that those businesses ought to always be DTC. What's the point in selling in a sporting goods store necessarily? You're always going to have the ability to personalize the experience better in DTC. Because again, unlike food, I'm not buying a weighted vest, or some sort of red light therapy or a Theragun or something like that. I'm not buying that thing every week. I'm buying that at a point in time. And so direct to consumer is a great route to market. In fact, one of the questions we ask a lot about companies that are solely in direct to consumer is if they come in and say, yeah, we're 100% DTC and we want you to invest in us because our growth model is to go into retail. I'll ask a lot of questions around that. It's wait a minute. Again, welcome to the jungle. when you start paying slotting and you start having to have merchandising requirements and you're looking across the table from a buyer who's got 10 other people who are vying for the shelf space, it's not necessarily a harder ball game, but it's a different ball game than the one that you're in. And so, if you don't have proof that you can go and play there, it's hard to sort of decouple it. So, Jason, it's really one of those things where it really is dependent. Again, back to your question, it really depends on the type of business you're in. I would tell you for the vast majority of food and beverage businesses, you want to see omni-channel, though, and we can talk more about this. That does not mean blowing your brains out with doors, points of distribution. One of the things that you did really well is, go narrow and deep. I don't have to be everywhere, but if I can go to Whole Foods and build my proof of concept, well, then what can come after Whole Foods? Maybe places like Target, hypothetically for the new Primal, but but like those are the types of things that like, allow you to ultimately kind of get to the right channel mix. And it just varies tremendously by the type of business you're in.
Yeah, that's a good point. That it's not a one size fits all, and I like the analogy of the frosting on the cake for food, in particular, because it was interesting. I didn't know anything. Like I didn't know enough to know, but I didn't know anything about direct to consumer. So but I knew I could build relationships. So in the beginning, I was just calling retailers. I didn't even know that like direct to consumer would be a thing for this. But if I just look at my own behavior as a shopper, I do all of the things that you just said. I order on Instacart. I go in the store. I order on Amazon. There's a Target pickup or whatever it might be. I mean, all of those things occur in my household like every week. Every week. So you kind of have to, at some point as you scale, right, you have to show that you have the ability to perform in all those places. Got it.
Or at least the ones that matter the most, Yeah. And I think the point you just made that is true is that in food and beverage, obviously like having a great online business for your most loyal customers is great. I mean, we have plenty of subscribe and saves at Amazon in our house on things that we like love the most, but you're always going to go and have a role for, the broad mass in food and beverage exists outside of DTC.
Yeah.
So you kind of have to play there, whether you want to or not,
Yeah, totally. Yep. Okay. I got two good ones for you here. I want to talk about founder psychology. You've been around a lot of founders. You've been around a lot of founders in your time. Yeah. All right. And you've probably seen everything from like the really passionate founders that are like burning out, and you've seen ones that are clinging too tight to the wheel. When do you think it's time for a founder to like, or what are the signals for you when it's time for a founder to either level up or maybe step aside? And then how do you broach that as an investor?
Well, so I'll answer your question, but I'll also tell you, because you mentioned different types of founders that I've worked with. The type you didn't mention are the amazing ones who, really, really were world-class in what they've done. And I've had the benefit of learning from a lot of them. People like John Foraker at Annie's, people like Matt O'Hare at Vital Farms. I mean, I could go on and on and on just I've seen a lot of good. I've definitely seen a lot of bad and ugly too, and so, you do, to your point, you do sort of start to, the student in me is kind of like, okay, pattern recognition. Like, what do you see, that works and what doesn't. And, I honestly think the biggest thing is I would tell people, like, stay self-aware as long as you can, because what tends to happen, and you do this, there are other players in my portfolio, CEOs and founders in my portfolio that do this. A guy named Jesse Merrill, who I know is a good friend of yours at Good Culture.
Yep.
They're just killing it in the cottage cheese business right now. The common theme is just when you've got self-awareness on, okay, here's what I'm really, really good at, and here's what I'm not good at, and just the ability to call that, as long as you keep that self-awareness, then what happens is you build your team with experts. You know, like, hey, it's time for me to hire, a marketing person, or it's time for me to maybe bring somebody in who can manage my supply chain for me because I can't do it all, If you're self-aware, I actually think you can keep going for a long time,
Yep.
When Matt O'Hare is a great example of somebody who I know, good friend who founded the Vital Farms business. And Matt knew for a long time, honestly, that the public markets would be the place to go and really realize his vision. I mean, his vision was, why are pasture raised eggs 2% of the market when you think about the societal impact, and then just also the taste of the egg? The egg is different when it's pasture raised versus conventional. Crack two in a bowl side by side, you'll notice it right away. Taste them, you'll notice it right away. Matt knew that for me to really achieve my objectives, I got to be able to play in the public market someday. And he was like, I'm a great entrepreneur. There's no way I'm a public company CEO. Like, I'm going to bring in Russell Canseco, who is running that company now as a CEO, took it public, has driven massive growth. Again, the common theme there is just self-awareness. So the flip side that I'd tell you, when you start to think that, like, hey, I got this, I can do everything here, like, hey, last time I checked, I'm the guy who started this company. Last time I checked, I'm the one who brought the company to 100 million in sales or 50 million in sales or whatever. When you start to get too much hubris around what you do, that's when I have seen the blinders go up and people are just like, look, why isn't so-and-so seeing the writing on the wall on how powerful bringing on a head of marketing would be or a head of sales would be,
Yep.
Those are the places where you just sort of wish you could help people see, like, sort of to some extent the forest for the trees, because, when you try to do it all, what happens is you put yourself in a spot where you can't do what you're great at. Like, because you as the founder are great at a lot of stuff that nobody else can replicate.
Yep.
Honestly, the answer to your question is just self-awareness tends to be like a really, really common theme. When you got it, you can go a long way. When you don't have it, there's a lot of booby traps that get set that you can fall into,
Got it. I love the self-awareness conversation. We could have an entire discussion around that alone.
Yeah, it's true. And and to your point, you talk about like sitting down on a couch and like going into the psychology of it. Like there's a lot of deep stuff, and like, what makes people self-aware, what makes people, lack that, what makes people coachable, what doesn't. I mean, it's really deep stuff. You're right.
Gosh. I'm going to leave that one at that, because if not, we'll go off on 6 more bunny trails, and I want to make sure that we don't do that. You mentioned the mission of Manna earlier, and working on better health, wellness, better food systems, quality of life, and in the later years in particular. But how do you balance that with hard numbers? Like, what happens when a brand is like fully mission aligned, but maybe messy on the financials?
Yeah. One of the things I like to say all the time is that our mission at Manna is to help people live better longer while driving outsized returns for our investors. And the reason that's important to say is it goes back to, like, we got to remember who, like, we're managing other people's money, in addition to some of our own, we're managing other people's money. And we got to keep that focus, because the truth is, if you want to have an impact, let's just step back and talk about impact, and a lot of this was wrapped up in ESG and some of the other things that were, hot for a period of time, cooled off now. But if your goal as someone with money is to have impact, I could give you so many worthy not-for-profits that are out there that would be really worthy places to go and put your money, that would help you have impact, would help you improve the world, would help you do all those things. And there's a role for that in kind of how we all spend the resources we have. But when you're playing the game of business and you're trying to have impact, I always say, like, we're not a not-for-profit. The way we have our impact is to have a healthy P&L that allows us to reinvest in the business and create a multiplicative effect on what we're able to do. That was always one of the things that I loved the most about Annie's. I was at General Mills and leading that portfolio of emerging brands when we acquired Annie's. And again, you get to know people like John Foraker but to be honest, everybody at that company, they viewed it as, look, the way for us to go and get more certified organic grain out there, the way for us to go and replace the, synthetic Dayglow orange Kraft mac and cheese with, Queen Annie's mac and cheese. The way for us to do that is to have a healthy business, because if we've got the ability to control our own destiny and self-invest and not be reliant on other people's money, we've got the ability to go and get into other categories kind of as we see fit that we think could be cleaned up, Like in the case of Annie's, they were like, hey, how about we get into fruit snacks? There's a lot of really junky fruit snacks out there, and we think there's a better way to do it. All of that was fueled by having a good business with good unit economics. I sound like a professor when I say that, but unit economics end up being the blood supply, the oxygen that allows you to go do what you want to do. And so, if you're in the game of business and you're trying to have impact, it has to be inextricably linked with a P&L, is the way I see it. Otherwise, you're just competing with other not-for-profits that could be a place where people can go and put their money for impact, And so it's hard to decouple it. It is is what I'd say, Jason.
Okay. I'm a testament to this. Once upon a time, I had this moment in time where we were launching products. It felt like every other month. And we had this partnership at Whole Foods where it was almost like every conversation we had, it was around innovation and what we were going to launch next, whether it was driven by them or us. And there were, easily a dozen products I launched with terrible unit economics, but for the greater good. But like, to your point, all that does is just drain all your cash, and then you can't go do any greater good. And so it really kind of ties your hands. So I am a testament to the economics class that we just took, that it's spot on. They're inextricably tied.
And the thing is, like, on your business, like, the thing I think about, like, again, like, I think some of what you were talking about predated our partnership together, but even in the time I've known you, like, you've gotten so focused on your meat snacks business, and to be clear, even more focused on things like Snack Mates. And so when you think about, okay, how much junky food out there, how much junky food is there that kids eat? How much food is that is it the kids eat that has no redeeming nutritional value whatsoever?
Yep.
By focusing on Snack Mates and, like, driving that like you are, like, that's a real high impact way to make sure the kids are actually eating stuff that's better for them.
Yeah.
And like, you wouldn't be able to do that if you were, like, spreading yourself across 12 different fronts.
No, you're spot on. And to your point, all of that innovation predated the Manna Tree relationship. In fact, it was the Manna Tree relationship when we sat down at first and went, okay, we got to narrow this focus quite a bit. So I credit the team there and working with everyone there to kind of really get it dialed in. But yeah, you can't fight a multi-front war. You just can't. And as much as entrepreneurs get really excited about going and disrupting all of these different places, like, the multi-front war is really hard to fight. And so
it burns a lot of cash, and so it goes back to, like, where you started, which is, okay, you do all those things, you burn cash, you need more money. And now I get stuck spending, as a founder, 75% of my time raising money. Like, okay, we've lost the plot when that happens.
Oh my gosh.
So, and again, like, I know that everybody, so many people in our business know that, but it's sort of that oxymoron, or that sort of contradictory type thing, that, like, sometimes the fastest way to do more is to do less,
It's a lesson I learned the hard way. So, if anyone out there listening, the fastest way to do more is to do less. I absolutely love the statement. I might actually frame it and put it on my wall in here. It's a good one.
Okay, now you're blowing smoke up my ass.
No, it's a really good one. I really do appreciate it. I'm going to go rapid fire on a handful of questions here. I just want to get in your head on some of this. In your opinion, let's bust a myth. What is, like, the biggest fundraising myth out there? Like, you need a perfect pitch deck, or valuation is everything, or, something in that lane. What's the biggest fundraising myth in your opinion?
Biggest fundraising myth is that you can hide from reality. I have so much respect for people to come in and say, here's the good in my business, and this is the place where I want you to help me accelerate my growth. And here's the bad. These are the things that are not going well, and these are the actions I'm taking. I have so much respect for people to come in and say, like, here's a balanced scorecard of who you'd be partnering with. And so often I see pitch decks that are nothing but happy talk, and it doesn't work,
Oh, that's so good. You're right. How many pitch decks are full of sizzle, and, like, you don't get any, like, do your own SWOT analysis. Like, bring your own SWOT analysis to the table.
Totally. Help me understand. And, like, truthfully, like, come to me and say, hey man, these are the snakes in the grass in my business, but here's what I'm going to do about it. And here's where you can help me, it's a myth that, like, you got to make everything look pretty.
Hide from reality. Steve, maybe. All right, I'm going to move on, because that might be my favorite answer I've had. Is there a CPG trend that you're over? I'm sick of hearing about it. Sick of seeing it. There's enough of it. What's a CPG trend that you don't want to hear any more about?
Oh man, that's a really good question. Oh God, I think you got me on this. Um, Jason, what's a CPG trend that you're really sick of hearing about?
Well, I can tell you what I was sick of hearing about, and I'm no longer sick of hearing about, is plant-based meat.
Well, okay, there you go. I mean, that's a good one. Yeah, yeah, that's actually a really good one. Like, so thanks for the prompt on that, because I will tell you that, like, one of the things that really kind of pisses me off about that whole thing is that there are like legit plant-based protein companies out there, and legit plant-based companies out there. And now it has just become like a little packaging flash that everybody and their brother puts on everything. I've seen so many things that say plant-based, and it's just sort of like, I mean, I'm just done with it. I'm also sick of like the whole energy space, to be very honest with you. Like, energy drinks. I mean, it feels like everywhere you go, it's some new twisted take on energy.
Yep.
I don't know. It's a great question.
Those are two good ones for me. I would say, it's personal on the plant-based meat stuff, because like, the USDA regulates food claims on the meat side pretty heavily. I mean, far more involved than the FDA on a day-to-day basis in like the active regulation of what you can say.
Yeah.
And like, to the extent where, like, when I launched a grass-fed beef jerky product once upon a time, I wasn't allowed to say that. I had to say beef jerky, and then I had to say made with grass-fed beef. So like to the point where they're regulating that. But, there's plant-based chicken. And I'm like, no, it's not plant-based chicken. It's a plant-based protein product that it made to taste like chicken. Like, but you can't they're not the same. Chicken and plant-based aren't the same. So I have an issue with just like some of the intricacies of that. But also, like, to your point, like, it was total. I think it was Seth Godin who said marketers ruin everything. And, we took it too far. We just went too far with it.
Well, it's exactly right. And the thing about that is that, and there are so many companies that had spectacular failures because of it. People that come to plant-based products often do it because they're rejecting meat.
Yeah.
And so the idea that, like, okay, well, I'm going to make meat that tastes, I'm going to make plant-based meats that taste like meat, but they're made from plants. How many people actually want that? I mean, it just was a complete miss of the consumer.
Yep.
So yeah, good one. I should have been more on my game, man. Thanks for the prompt.
No worries. What is one? We'll reverse the question. What's a trend you're really bullish on for the next 12 or 24 months?
Protein, and clean labels and minimal processing, I think are two that are going to be here. If we were talking together 5 years from now, we'd be talking about both those things. Part of why, protein is, coming into focus as a building block for so many things. When you start talking about eating in a more positive kind of, way that's consistent with longevity and health span. And I think we're just getting started on making protein more available to people. And then similarly, like when you think about clean labels and kind of minimal processed, I think we're also all learning that, the processing that happens in too much food that we consume has unintended consequences on our bodies. It has unintended consequences on the broader supply chain. I heard this the other day, and I really like it. Like, how many foods are you eating each day that are single ingredient foods? And you ought to start there. Like, that's pretty profound, actually.
Really profound.
Because the reality is, like, A, that's really hard to do, and B, like, I don't think people really think about it that way. Like, there's a lot of processed stuff out there, and I think we're just getting started on shining a light on a lot of it.
Yeah, fully agree. Okay, two last questions, and we'll wrap it here. Do you have a go-to question when you're trying to really find out what a founder is made of?
Coachability is the number one thing that I look for in a founder. And so it's not a question per se, other than I do want to roll around in the failures with people. Like, I want to roll around in, like, what I want you to give me something that, like, went wrong, what you did about it, what you learned from it,
Really good.
And again, like, that's not, it's funny. Like, when I talk to people, like, I don't think I ever ask it that way, but lessons learned, being a student of the game, like, that's so important to me. Like, the reality is, like, none of us are going to get everything right. In fact, most of us are going to get a lot wrong, you know? And so if you learn from those lessons and you're wired that way, you can do anything.
Yep. Love it. Love it. Okay. Sweet or savory on a long diligence day? Sweet or savory snacks?
Savory.
Love it. All right. Give me a quick Manna Tree blurb. If people wanted to get in touch with you or anyone at Manna Tree and they thought they might be a fit to work with you all, or for you all to consider them for an investment, give me the quick high level. We've already talked mission, but who at what stage and what should a brand start to look like when they give you a call?
Yeah. So, I mean, we're so we are health, like I said earlier, we're health and wellness focused. Our whole mission is to put growth equity and operating expertise behind companies that are trying to help people live better, longer lives. That means food and beverage. It means active outdoor lifestyle. It means clean home, beauty, and environment. We are, I'll tell you, like, a lot of times in our business, like, people get hung up on check size. I mean, and I could give you an average check size. Like, we're trying to write $50 million checks now into companies. And so, that you're when you start doing the back of the envelope on, okay, ownership percentage and how does that translate onto a cap table? We're really looking primarily for companies that are doing kind of 50 million and up right now with kind of our latest vintage of fund. But the truth of the matter is, I could give you exceptions on the high side of that, and I could give you exceptions on the downside of that. It's really less about check size. It's more about, like, do you have a good proof of concept? And is there an opportunity to scale? And are you wired as a founder to want to, like, roll up sleeves and kind of partner together? Or are you just frankly looking for a check? I think we're looking right now at smaller companies, a couple of really interesting smaller companies that will be well below kind of what, the numbers I just gave you. But so to me, it's less about sort of the check size, and it's more about kind of where you are in your life cycle and whatnot. And so that's sort of who we are. We can do different types of investments, minority investments, control investments, buyouts. I mean, it's less about the type of investment and more about, like, do we really see the end game together? And, how do we roll up sleeves and kind of do and build that together? And again, you can check out our website and look at companies, again, like yours, Jason, that we've partnered with. We're really proud of our roster, and, are just looking forward to building it out more.
Love it. Steve, there are so many golden nuggets from today's conversation, and I am eternally grateful for you taking the time to spend it with us and to share it with the broader industry. I know a lot of people are going to be better for this conversation. I took copious notes. I hope other people do too. Yeah, and I appreciate it.
You are way too kind. And I would also tell you that I think, obviously all the work that we're so proud to partner with you on your new Primal business. And you've got so many of the things that I just talked about. But I mean, even this, Jace, like, I think this is awesome that you're doing this. Like, so many of the best people in our business find ways to just give back to the broader ecosystem. And just, everything you do with this podcast, everything you do on LinkedIn, you're not just kind of self-serving. You're really trying to give back. And I give you huge props for that. Really impressive stuff.
Well, I appreciate it. Thank you so much.
Cool.
And thanks again for being here.
Thank you.